Hello, James, and welcome everybody. How's everybody doing today?
Good. Yeah, great. Alex, thank
Doing
you for
good.
the opportunity. I appreciate you and Sarah and Jessica organizing the event and appreciate the opportunity to talk about Tesla and my forecast for a while. I always enjoy doing that.
Yeah. Super excited for you.
Anybody remember what the keyboard command is to record your screen? I think it's Windows Control R. Is that right?
Not sure. I have a Mac.
All right. Well, I hope I did it right. If we didn't, Sawyer's recording on his screen.
Yeah, I'm all good.
All right, good
Okay.
stuff.
So I don't think you need any introduction of yourself. You've been praised by Elon Musk for your excellent insights over the years. And so we're all excited to hear you start. And, well, let's go.
All right, sounds good. So hopefully people are following along on Miro. That link is from the X Podcast Twitter account if you haven't seen that yet. But let's go ahead and launch in to the forecast. I'm on slide number 1 of the tweet right after the title slide. And this is my overview of my forecast. I always start with this one. I've had this slide for a few years now. And the story has remained the same up and to the right with Tesla deliveries and revenue and more revenue than costs. So back in 2017, Tesla was still losing money, and for the first part of 2018 a little bit. But this has been my introductory forecast summary slide the whole time I've been doing a forecast, even before I had a detailed forecast model together. And I just wanted to convey the idea to all the long-suffering Tesla shareholders that profits were coming. Profits were in the future for Tesla. It was only a matter of time before the economies of scale paid off with profitability. So, the top of the page, I'll just walk you across that really quickly. This green line is the revenue. The revenue is shown on this y-axis over to the left. And then the other dollars are also over here. So the costs are in gray. I've got a dark gray for variable for the fixed costs, and I've got a lighter gray for the variable costs. And then over here on the right axis, this is talking about how many vehicles did Tesla deliver in each of these quarters across time, and what do I think they're going to deliver in the future. My forecast is off to the right here. So there's a correlation here. The more you sell, the more you make. The short seller's cry for many years was the more they sell, the more they lose. And that was the tweet from Tesla Charts that Montana Skeptic was so happy to write about on Seeking Alpha when he plotted an XY scatter plot of Tesla's deliveries against losses, and there was almost a perfect correlation. The more they sell, the more they lose. That was a short-sighted analysis because it failed to recognize the elementary business lesson that there is a break-even point beyond which profits will occur, so long as your variable costs are less than 100% of your revenues. All right, so this is a P&L summary below the chart that mirrors what's happening in the graphics. So the green font here for revenue is paired to this green line up here. So you can watch it as numbers, or you can watch it as it climbs across the page. Same thing with the cost of sales. Those are the variable costs. And then my profit metric that I've highlighted here is adjusted EBITDA. That's the metric that I think is the most meaningful for an investor who cares about when is this company going to become profitable. Once the adjusted EBITDA flips to positive, you've got hope. And the bigger that number gets, the better, of course. So that's before interest, taxes, depreciation, and amortization. Those are items that are beyond management control. If you're the CFO, there's not a lot you can do about how much you have to pay in taxes or the interest on old debt that was already saddled to the company before you took over, maybe. or the depreciation and amortization on, fixed assets and contracts or whatever you had already committed to. So that's why I like adjusted EBITDA. It's the profit that happens before those costs hit. And then for operating expenses, I had to put a footnote on here because I was confusing people. This does not match the number reported as operating expenses in Tesla's earnings release, because I'm trying to compress a whole P&L down to only 4 rows, and that's really hard to do. You're going to have to bucket a whole bunch of stuff together. So I'm putting everything between revenue and adjusted EBITDA that isn't cost of sales on that operating expenses row, and that's this fixed cost that you see here. It's not exactly fixed. It does climb over time, but it shouldn't be variable based on the volume produced. It should be variable based on how big the company gets, right? So I've got the deliveries on here. The deliveries are this blue line. And then I've also shown the GAAP and the non-GAAP earnings. And people do care about what the non-GAAP EPS is. That's the earnings number that Wall Street cares about. They don't care too much about the GAAP number. So I'm forecasting $1.55 worth of non-GAAP EPS in Q3 over here. And that's not a lot more than the earnings that Tesla generated in Q2, but it is an all-time record. So anything beating $1.45 would be a new record for Tesla. And I've also shown Rob Mauer's favorite metric on here. If you don't follow Rob Mauer and you're a Tesla fan, what the heck are you doing? He's the best source for daily Tesla information available. And this is his favorite number, automotive gross margin excluding regulatory credits. So that is before Tesla sells any regulatory credits, how much money is left over after you collect the revenue from delivering a vehicle and paying for the costs of producing that vehicle and delivering it to the buyer. That's what automotive gross margin is. It's telling you how many pennies you have left per dollar of automotive revenue after covering just the cost of getting that to the buyer. So I've got that number coming down a little bit, and we'll go into why that is later. That's all I've got for this first slide. I promise I will not spend this much time on every slide. We've got 69 of them, and some of them are a little more duplicative than this. So if there are no questions on this one, I will proceed. And I should say we're going to hold question and answer session until the very end because I may answer your question just in the natural course of going through these slides. So if it's something that I don't touch on, then feel free to ask at the end. And I'll trust Alex to be watching the queue for people who want to ask questions. All right. I'm moving on now to slide 3, and this is tweet 3 of my 69 tweet forecast thread that you can find on Twitter if you follow me. My Twitter handle is @ICannot_enough. And this has been one of my favorite charts. I get a lot of positive feedback from people on this one. Look at Tesla's revenue growth since 2009. You can almost not even see this little sliver that represents $73 million. If there were $73 million extra dollars in your bank account tomorrow, you would notice. That's a lot of money. But on this chart, it doesn't appear to be a very big number. And then since 2009, you can see how Tesla's revenue has grown year after year, quarter after quarter. They're all on here. I made this chart on Flourish, which is a great website to use if you want to make colorful charts in a preset template. This was a good one. I was happy with this chart when I made it. It's just dropping in the quarterly revenue amounts, right? So in 2017, for the whole year, Tesla made $11.759 billion. They're going to post more than that much revenue this quarter. They've been averaging almost that much in the first 2 quarters of this year. So just tremendous exponential revenue growth despite ASPs falling, which we will see later. When I say ASP, that's average selling prices or the revenue per delivery, automotive revenue per delivery. So Yeah, if anybody tells you the growth story is over, here's a chart you can show them to right their wrongs. All right, on to slide number 4. And I've caused some confusion with this one. I don't think I explained this chart very well when I tweeted it out. This is a sexy chart. And when I say sexy, of course, I mean S3, X, Y, Model S, Model 3, Model X, and Model Y, the 4 vehicles that Tesla is selling today. And these are just stacked bar charts that show you how much of each of those Tesla was selling. They introduced Model Y at the beginning of 2020 with this tiny little gray bar right there. And it's been growing ever since. Now, in 2021, you'll notice the red and the blue bars drop out completely. This was for the Model S Plaid refresh, and Model X is just starting Plaid deliveries after a long hiatus. So pretty remarkable what Tesla has been doing this year on the strength of really only the 3 and the Y. Really only the E and the Y of sexy have been working for Tesla's deliveries so far this year. And the other new thing about this chart, for this time I posted it, I did change the color of the Y. It used to be yellow. I made it gray, light gray. I think it looks a little more professional that way now. But I extended out to show you what I'm forecasting for 2023, 24, and 25 for the first time. So there's a lot of exciting growth here, and this is only factoring in the capacity for the gigafactories that are in place today. Maybe we'll find out sometime soon that Tesla has plans to build some more. It doesn't sound like Elon has any immediate plans to make that announcement. It sounds like he's going to start thinking about it soon. Got to do some more growth. And these are conservative. Tesla can beat these numbers, I think. It's always dangerous saying you think your long-term forecast is conservative because sometimes things take longer than Tesla hopes they will. So I hope this is a conservative forecast. I'm going to move on to the next slide here. This is Tesla's global deliveries on slide 5 now of Model 3 versus Model Y. And I wanted to put this chart in so that we can see visually the story that Elon and Zach have been stressing on earnings calls, which is that Model Y is going to outsell Model 3 and it's going to keep going, right? So you've got really what's an excellent growth curve here for Model 3 with all sorts of little hiccups in here for different reasons. You know, Q1 of 2019, that was the homologation and shipping to the EU for Model 3 for the first time. So there were a lot of vehicles left in ending inventory that quarter, which they couldn't get delivered by the end of the quarter. The wave did not pay off that quarter. And, you know, your factory gets shut down in Q2 of 2020 for COVID for 7 weeks. That's going to put a dent in the growth story for Model 3. Hard to deliver vehicles when the Alameda County authorities have closed your factory for health reasons. But the growth story has been pretty good for Model 3, and I'm expecting that to continue into the future. But they're going to be usurped by Model Y, which you see enter right here, and come across, and just keep going. So I think the early part of 2022, we'll see Model Y pass Model 3 and just keep on climbing. Now, some of you may be asking, James, how do you know what the breakdown is between Model 3 and Model Y? Tesla doesn't report it. I wish they would report it myself, and I've left Elon that feedback before, and he said he doesn't think that much detail is useful, or that it, you know, or that its use would be to use the information against Tesla by its detractors. So I can see the point he's making, but to someone who does a very detailed forecast, I sure would like him to change his mind on that one day and at least retroactively, maybe after a long moratorium, release these numbers. So the numbers that you see up here are what Troy Teslike believes is the breakdown between the two models, which for my money is as good information as you're going to get. Also, sometimes Tesla's Director of Investor Relations, Martin Vieca, will include a chart in the earnings release that's just Model 3. And with a little clever sleuthing, you can use that graphical information to verify that you've got the right numbers for Model 3 by charting the numbers yourself and comparing against his chart. And then you can see, yes, these are the right numbers. Then for the forecast to go quarters, my numbers are going to diverge from Troy's. I'm forecasting out farther than he is, and I'm trying my best to not look at what he's forecasting so that we really get independent forecasts from him and from me based on what we think the capacity is, because there certainly is enough demand. Tesla can sell all the vehicles they can produce for the foreseen future. I'm going to move on to slide 6. Slide 6 is showing total Tesla quarterly production and deliveries. So one of the pieces of feedback I got on my forecast thread was, hey, these numbers out here don't match your sexy chart. Well, they don't, because this chart includes more vehicles than just S3, X, and Y. We've got Cybertruck in here. We've got Semi in here. There's an amount you definitely cannot see for Roadster. Those are going to be very small deliveries. And then I also think there's a couple of unannounced models that have been hinted at previously, one from the Berlin Design Studio for the European market, and another for what Shanghai ought to be building next as soon as the costs per vehicle will allow them to sell a more compact vehicle at a lower price. That's what I expect we'll see next from Tesla in China. So the red line is production. How many did we make in that quarter? And the dotted white line is the deliveries. How many of them got transferred to the buyer in each of these quarters? And there's been some little disconnects. They look very small on this scale. They look a little bigger if you set this y-axis down to a smaller figure. But Tesla's going to be able to sell every vehicle they can make for a long time to come. That's what I expect. All right, let's move on to slide number 7 from the deck. This is adjusted EBITDA by quarter, and it looks nutty. There's a lot of positive numbers on here, which is great. You want your EBITDA, adjusted EBITDA, to be positive. This is one of the metrics used in Tesla's 2018 CEO performance plan for Elon Musk. He's supposed to be able to vastly increase Tesla's revenue and adjusted EBITDA and market capitalization, the value of the shares, to levels far beyond where they were in mid-March 2018 when that agreement went into effect. And he's going to hit all of the EBITDA targets. There's 8 of them, and they're close to being fulfilled. And then on the revenue side, even though Tesla charts famously said that the $35 billion revenue, the first tranche of revenue, would be the only one that Tesla would ever get, because he thought they could never be profitable. He was wrong. The 55 is here, and the 75 is coming real soon. So, yeah, check out this EBITDA. So why the vertical climb in 2024? That's a good question. I don't have Robotaxi modeled separately in terms of how many of them will there be, how many rides will they be giving, at what average revenue per ride, etc. But what I do have is an assumption that the price of FSD is going to increase over time. So it'll be gradual, which is a lot of what you see here. And then, Tesla's going to figure out how to be more efficient going forward. how to remove parts and processes. The best part is no part. The best process is no process. How to find better components. How to smooth out sourcing, logistics. They're going to be paying less tariffs in the future. They're going to have less shipping expenses in the future by having production on every continent where there are buyers. And so that's what a lot of this profit improvement is. Volume is another big piece of this. You've got the rate piece and you've got the volume component. And then a lot of this climb here is my expectation that the price of FSD will continue to rise. And the revenue per vehicle will rise with it with no corresponding variable cost, right? When you charge somebody more for full self-driving, you don't have any costs increase along with that decision. So it just drops straight to the bottom line. That's the kind of flow through you're looking for if you want your business to be more profitable. All right, another one of my favorites. So I put 4 different charts on this slide. This is slide 8. And all of these are called profit. The one at the top left isn't really profit, gross profit or gross margin after cost of sales. That's not really profit yet, but it is a good figure to look at to see, is it growing over time? Are your rates and volumes improving? Are they net positive and gaining over time? And you see that the trend is up. So that's the gross profit. The adjusted EBITDA at the top right quadrant is my favorite profitability metric I mentioned earlier. So we've gone from negative EBITDA early in 2018 to positive numbers every single quarter since. Then on the bottom left quadrant, you've got non-GAAP earnings. So those were negative longer than the adjusted EBITDA was, but they've been trending up pretty strongly over here. I like this. That's a good pattern. Let me grab a line over here and draw out of here some. That's well, I guess I got the curvy line, didn't I? Maybe you want to undo that. Maybe just grab this highlighter. Why not? Yeah, check it out. That's what you want. You want one of those to happen. And that's what we're seeing from the non-GAAP. This is the Wall Street earnings number. And then over here, for those who really want to complain and say, yeah, but the GAAP earnings are still negative. Well, 2019 called and they want their FUD back. That's no longer true. Tesla is making money now and has been for a while, so get with it. So show this to your favorite Tesla hater who thinks that Tesla's still unprofitable and change their minds. It's not too late to change your mind on Tesla and get on board. All right, slide 9, I just advanced to. This is Tesla's quarterly revenue. And if this one looks a little different to you, it's because it's not my format. I stole this format from Tesla charts. So let me grab the box tool over here and see if I can do any better than I did the last time. So this is how this thing looked when Tesla charts tweeted it out. It was just after earnings had been reported for Q2 of 2020. And the point of the chart, of course, was to say, look at this, Tesla's revenue is not growing. This is what we call an orphaned chart because it hasn't been seen since. Funny that after this quarter hit, and this one, and this one, and this one, he didn't want to tweet that out again. What if people wanted to know what the revenues were? Tesla charts was not telling people. I guess he would just say it was fraud. These are all fraud over here. That's all they have left. All they have left is to call it fraud. All right, so these two are in red instead of gray because those are my forecasts. These haven't happened yet. But I will tell you, I'm at $14.6 billion for revenue, And Rob Maurer is also at $14.6 billion for revenue. So if we're both wrong, at least I've got good company. We're literally apart by $0.003 billion on this estimate. So I felt a little better about mine when I saw his. Let's move on to slide 10. All right, we got Tesla quarterly regulatory credits revenue here. This had been a darling talking point of Gordon Johnson and a few others, I guess. It still is for him sometimes when he has nothing true to talk about. But yeah, regulatory credits really came in at huge increases in 2020 over 2019. And this is when Tesla was, just crossing over from losses to profits. So these regulatory credits really helped a lot. What are regulatory credits? I'm glad you asked. So regulatory credits are the money you take from your competitors' ineptness. So when your competitors are unable to comply with laws requiring them to produce a minimum number of electric vehicles, and they don't, they're stuck paying a fine to whichever government agency put that regulation in place, unless they can purchase regulatory credits from other companies that made more than they need. Well, Tesla has made more than they need after they sell their first vehicle. Because Tesla doesn't have any gasoline engine vehicles to count against their score. So Tesla's free to sell all of their regulatory credits to others and still be in compliance with the law. We saw a little downturn in this number from the all-time high of Q1 2021 last quarter. I think we're going to see this continue to rise, not because the regulatory credits per vehicle are going to rise, but because the number of vehicles sold is going to continue to rise. So we'll see that later on in the detailed forecast. All these charts are the product of doing the detailed work, making all the assumptions, which we will see at the end. Let's move on to number 11. Slide 11.
And all as the regulations get more and more strict.
Well, tell me what you mean by that, Omar.
For example, various regulations and penalties on technologies are essentially driving up the cost of ICE and increasing the need for things like regulatory credits over.
Yeah, I sure hope they get stricter over time. I sure hope these goals go higher. There ought to be more electric vehicles being made. That's my position on the matter. I like Tesla because Tesla was way out in front of this and actually cares about it. Everybody else is just trying to minimize the expense that they owe from continuing to produce gasoline cars, and they're trying to get by in compliance cars that people don't really like that much. But that's probably more editorializing than people are here for. Yeah, but good point, Omar. Let's move on to CEO Performance Award quarterly expense. This was a bear to try to forecast. I have to because I'm forecasting earnings. And one of the things that happens between the revenue line and the earnings line is that you have to, under GAAP rules, declare some expense, even though it's a non-cash item, as progress gets made towards performance milestones in a stock option package. So if the stock option package requires certain business goals to be met, then as those goals become likely, you have to start declaring expense on them as they become more likely than not to occur. And then you get to declare expense prorated relative to where you think you are relative to the date that those options will be achieved and vest, meaning that they're able to be exercised by the recipient. I can't really do a better job than that explaining what these are, but they're a pain in the neck to try to forecast. You need a big spreadsheet, and it took me a while to build it. But I had some spare time on my hands, and I was happy to have called these big increases that happened from 2020 into 2021. These were happening because the market cap was increasing by leaps and bounds over this time period. At the same time, the revenue and EBITDA were improving a lot. So that meant that a lot more of this non-cash expense, it's just a GAAP rule. You have to put it on your P&L even though it's not real. Yeah, and you can see most of it's been paid already. So as of 2021 Q2, we're already close to 1.8 billion. Why does this chart end at 2.283 billion? Because that was the maximum amount of value declared on March 21st, 2018 under a Black-Scholes model run against the specific options and their likelihood of being achieved. So there won't be more than a total of $2.283 billion worth of expense against this performance award for Elon. So there's about $500 million left to go on this. So there aren't going to be any real big amounts unless one of them surprises us right now. There's a lot of management discretion to how much you're allowed to declare, as long as you can get your auditors to agree that it makes sense. All right, so that's that one. This next one is a graph of same size statements. So if you don't know what same size statements are, it's the idea that it's hard to compare different companies against each other, especially when those companies are different sizes, right? Every company is different. Even if they're in the same industry, they do different stuff. They can have really different dollar amounts. So what the approach is that you can take is say, well, for every dollar of revenue, where's it coming from? If you break down their business units into divisions, which divisions are contributing the most revenue, which ones are not contributing very much revenue? And that's what this page shows. It's giving you, for the average dollar of revenue that Tesla makes every quarter. And I did apply a 12 trailing month average to these, which is one of my favorite tricks, to smooth out seasonality, because this would be a really jittery graph if I didn't do that, just because stuff happens each quarter that's maybe not all that meaningful. It's better to just smooth it out by saying, hey, Q1 is a bad quarter most of the time. Q3 and Q4 are great quarters most of the time. If I'm always looking at the average of the previous 4 months, then I never have to worry about stripping out the seasonality because it takes care of itself. So the thing I like pointing to here is the regulatory credit sales. I'll pick on Gordon Johnson again. He goes on TV on CNBC and he says, Tesla can only make money because of regulatory credits. Look how small they are. Like at the end of last year, they were 5 cents of every dollar of revenue that Tesla was making. And I think that's the highest they're ever going to be. I think they're going to drop back down again as Tesla makes more money from automotive sales apart from regulatory credit revenue. And then automotive leasing, I've got staying pretty steady. It's usually 3 or 4 cents of the average dollar of revenue. Energy, we keep hearing, is going to be a bigger and bigger part of Tesla's business, and I hope that's true. We understand that there's a lot of difficulty scaling up production of cells and buying enough cells from third parties to be able to make all the products that the market is demanding right now. So hopefully the more that problem gets addressed, the better off we'll be. Then for services and other, this is kind of the everything else of the revenue. So supercharger revenue is in here, and repairs and stuff at the service centers. And used car sales are in here maybe. Well, it might be over here. I'd have to look in the 10Q again to know for sure. But I will head to the next one. So similarly, you can look at how Tesla spends each average dollar of revenue. So we know where the dollars of revenue are coming from if you break it down. This one is showing us over time, okay, well, how is Tesla spending that money? And in the future, these costs are going to come down. The gross margins are going to get better for Tesla. What makes me think they're going to get this much better? That Tesla won't have to spend as much out of every dollar on buying car parts, manufacturing, buying raw materials, paying the labor to run the factories. It's because more of the revenue is going to be full self-driving that doesn't have costs that come with it, right? So the more of that you collect, whether it's from robotaxi commissions a la the Apple iTunes store, Apple is so profitable because they're getting all that money just for providing the platform where the commerce takes place. It's a really good corollary to the Tesla network robotaxi fleet, where individuals will buy those cars and add them to the network, and Tesla will take a commission on every ride with really not very much associated cost. So that's the main thing happening here, and it's why you see these other costs shifting back. Energy costs have got growing over time as their revenue grows. It's not as profitable a business because it's a very competitive business selling solar panels. Lots of people want to do that. Battery storage, Tesla has cachet and brand awareness, but there are competitors in that space as well. So you can't overcharge people in Tesla Energy by a lot and get away with it. And then services and other ought to be declining over time just because they're going to be less and less of the business or the cost base. Then you've got SG&A, excluding stock comp. That's more of a fixed cost. It ought to be getting smaller as the revenues grow. This everything else, excluding stock comp, is getting a lot bigger. And if you think about it for a second, Tesla's getting profitable in a big hurry. And I think at the end of this quarter, we'll be able to take a big tax credit from prior year's losses. The IRS does you a solid if you're a business that's losing money and has been for a long time. You're allowed to save up all those losses over time. That's called your accumulated deficit if you're an accountant. And then as your company gets more profitable and you start making profits, they don't make you pay taxes on those profits right away. They wait until you're back to even. So you're allowed to save up. They're like rollover minutes, your accumulated deficit. But there's particular rules about when you have to wait to use them. So my forecast is that in Q4 of 2021, Tesla will take a $1.6 billion favorable adjustment on their tax expense related to that one-time benefit from prior year's losses, because 80% is the most you can take in the first year under the accounting treatment. And then in Q1, take the other 20%. I have low confidence that that is going to be the timing because we don't get direction from Tesla on when they're going to do that. It's a pretty funny read if you find it in the 10K. The no guidance on when they're going to take the tax benefit. But after that, they're going to be paying taxes, and that's what you see as these increasing pennies. More and more taxes every year as more and more profit gets made. And that's what this green stuff is over here, the non-GAAP earnings. These are profits. Profits get bigger over time. You see these two little red guys over here. Those are losses that happened back at the end of 2018, 2019 on a 12 trailing month average basis, same as the previous chart, because there were losses in the quarters in Q1 and Q2 of 18. All right, moving right along. This is a chart I always include in the forecast thread because it's just a fun look, I think, at visualizing the relationship between inventory, production, and deliveries. So you see these numbers reported as numbers in the earnings release, and it's easy to just, move right past them. But the principle here is that you cannot sell more vehicles in any quarter than you had to begin that quarter, plus the vehicles you made that quarter. That's the maximum. Any vehicles that you do not sell from that available supply of finished goods becomes ending inventory, and that ending inventory becomes the beginning inventory for the following quarter. So that's what these little colored blocks are doing. They're showing you the relationship between, hey, why aren't production and deliveries always the same? They're just going to be different. It'll be a miracle if you ever have a quarter where the production and the deliveries are the same number. Really hard to get the logistics to work out that way, even if you're doing the wave, which is trying to produce the vehicles that have the farthest to go to be delivered early in a quarter, and the vehicles that have the shortest path to go late in a quarter, so that everything you produce during a quarter gets delivered before the end of that quarter. It's really good for your P&L if you can manage that, and it's good to have a low ending inventory on hand. So that's what this chart is showing over time. And I've got Tesla managing their inventory better. How are these not getting a lot bigger? I think it's because with factories on each continent, they ought to be able to get better logistics with less worry about putting things on ro-ros. When I say ro-ro, that's a roll-on, roll-off ship. You can't use a regular Maersk over-the-ocean shipping container to put cars in. You could, but it would be astronomically expensive, especially at today's rates. Shipping containers a year ago from China were like $1,500 to the U.S. Today, they're 10 times that. Literally, it's like $15,000. In some cases, $20,000 per shipping container, given all the global supply and logistics problems and container ships held offshore in the Pacific and California. You've probably seen the news. It's a failure of the just-in-time inventory model and these shipping companies not carrying enough capacity buffer to absorb a problem like the COVID nightmare that happened for them over the last year, where stuff stopped moving and you couldn't find places to put it, and then the orders came right back again, and there was no shipping capacity available to move it. But I will move on from that diversion to show you this stack to area chart. I wanted to make one of these to help people visualize what's getting produced at each site. So I guess I'll start here at the bottom, because these are the vehicles that Fremont has been producing. So Model S, Model X were getting produced long before 2018. Model X back to 2015, Model S all the way back to 2012, smaller numbers than this. Then Model 3 joined the party in late 2017 and ramped up here. And the Fremont is also making Model Y right now. So here's what they're making, and these are all quarterly, not annual numbers that you see as the scale on the y-axis. So Fremont is making more than 100,000 vehicles per quarter this year, and that ought to grow some over time. Elon has said that he's hopeful that 50% growth can happen. I don't have that much assumed. We'll hope. I've left Tesla some room to beat this number. Then for Shanghai, those started early 2020, late 2019. And at first it was Model 3, then they added Model Y, you see here. I think there's going to be a Shanghai Compact that starts ramping end of 2023 or early 2024. That's a guess. I don't have good guidance on when that's going to happen, but I think if they announce it in the next few quarters, that'll give them enough time to design it and build. We'll see if I'm right or wrong about that. Then for Berlin, we've got the Model 3 and the Model Y happening. They're doing Model Y first, and then they're adding Model 3 later, which is why you see these kind of inverted. And then Texas comes on board, Giga Austin, making a lot of Model Ys, a whole lot of Cybertrucks. I hope I've left Tesla, a bunch of room here to grow. Let me take a drink of water for a second. This is a lot more talking than I do all at once, usually. And then Semi. Oh, thanks, Omar. I appreciate you. So we've got the Tesla Semi up here on top. And it may look piddly compared to the others, but each Semi needs lots of cells in it. And the market for long-haul, over-the-road semis is not the same market as for passenger vehicles. So there isn't a 16 million a year U.S. sales market for semis. It's way smaller than that. So this would represent a pretty good market share for Tesla, especially early in the ramp for a product that we haven't really seen tested by companies yet. So my hope is that this number can grow a lot if there's tremendous 4680 cell production by Tesla and by third parties, if we can get them to produce those with high nickel content to enable a long range, high power, mega charging semi that hopefully by this point will also be at minimum platooning compatible, if not also full self-driving compatible. I think it'll be full self-driving, and none of these will need drivers in them by this point. But it's just a forecast. We'll see what happens. When you do a forecast, you know at the outset it's going to be wrong. You don't know how wrong it's going to be, but that's the liberating and the infuriating aspect of forecasting. Whatever you forecast, it will be wrong. Okay, on to slide 16. Now, I'm probably not going to spend as much time once we get past the charts to explain them, because these tables of numbers are less graphically interesting. But this is a different way of thinking about the earnings number. We think about earnings in terms of earnings per share, which is a good way to think about it, and that's fine. I wanted to take a different look at it because it's hard to compare against other automakers when they have really low market caps, and Tesla's has so much growth built into it already, rightfully so, in my opinion. And the way I thought to look at it is per delivery. What are your earnings if you divide them by the deliveries? And those numbers were negative, again, way back here at the beginning of 2019. And this is 12 trailing months to smooth out seasonality. And look at this growth. It's pretty great. Over $5,000 worth of GAAP earnings per vehicle globally is great. And then that went up to $6,000 in Q2. I think it'll go a little higher in Q3. And then I have this box here starting in Q4 to remind people that there's a question mark of will Tesla declare $2 billion worth of deferred tax benefits from prior year's losses here. They might. I'll sure be happy if they do exactly in this spot. But I have forecasted this to happen before, and it didn't. I thought it would happen in Q4 2020. And I guess either the auditors or Zach or somebody doesn't interpret the clause the same way I do. It's supposed to be when you're more likely than not to be able to wipe out your accumulated deficit. At that point, you can take the credit. That accumulated deficit is getting small, and this trend is not subtle. These profits are getting bigger, right? So it would take an unforeseen calamity to reverse this trend. Tesla's got the business model working and the flywheel is spinning up. So the profits are going to be there for them to take this benefit. I just don't know when it's going to happen. So that's what that box is about. But this is the regular reported non-GAAP earnings number. If you show this to your average Tesla Q short seller, they'll say, but what about regulatory credits? It's all regulatory credits. If you threw those out, that would be negative. Well, that's what I made this next chart for. This is exactly the same chart. I just changed the color of the bars to graphically distinguish. This excludes regulatory credits up here in the title. So even if you throw them out, and it is not statistically or accounting-wise valid to do this, the short sellers made this metric up. Non-GAAP earnings minus regulatory credits is not a thing. And also, you would have to tax effect the regulatory credits that you're removing because you're paying taxes on that money. So those taxes would disappear if the regulatory credits had not occurred. So whenever you see a chart that they've made, they didn't make that adjustment. I likewise didn't make that adjustment here just to show, hey, it's still profitable, guys. There's still a lot of profit left over, and it's going to grow over time. Tesla does not need regulatory credits to be profitable. So that's what this shows. And this is the last of the charts. I made it here already. In just 1 hour, I've made it through 18 tweets. So Zach mentioned on the Q2 earnings call that it's fine to look at quarter-over-quarter changes, and that has some value, but he prefers taking a longer look at the trends, what has been happening over a long period of time in terms of the average selling prices, the revenue per vehicle, which is this mountain range in the background, the area chart. Those ASPs have been coming down. They're on this right-hand y-axis. Average revenue per delivery had been 90 grand, and it is now less than 60 grand, you know, maybe a little over 50. So what you would expect ought to happen as your ASPs continue to decline is that your automotive gross margin, excluding regulatory credits, ought to be getting worse in sympathy. All things being equal, these percentages should have been going down the whole time. And you see a little area here where they were going down some. But look at this. They're higher over here than they were over here. Tesla's, and what this means is the cost per vehicle has gone down by more than the price per vehicle has gone down. That's the only way these percentages could be better than these percentages. So this is a tremendous compliment to the teams at Tesla and the hard work they do to optimize systems and processes and find cost efficiencies in the manufacturing process. This is not the outcome that would have been expected of a normal automaker. So really an impressive business dynamic visualized here. And that takes me to the next slide. So this used to be slide 2, back before I had all those fun charts in my presentation. And it's just a little summary that shows you, hey, how many vehicles am I forecasting by type? What's the automotive revenue per delivery that I expect, and how much revenue does that make when you multiply one by the other? So you can see those numbers here. Then, and I mentioned 14.6 million in total revenue. The reason this number isn't that number is this is just the automotive revenue. It's excluding the energy business and the services and other. The next slide is showing the income statement. So ultimately, this whole thing is about getting to the income statement. And it's kind of all on one page. Hey, what happened with the business? How much money did we make? What were the payments for services rendered up top? And then how much did it cost us to make those business transactions happen? So this first section is giving you the revenue breakdown by division. So I'm expecting automotive sales way up, over 2 billion here. Leasing and resale revenue, they kind of cheat and give us a percentage in the production and deliveries report that we can use to feel okay about these, applying some historical ideas for what the revenue per lease is. Make that adjustment to the revenue. Then I'm expecting some increase in energy generation and storage. Hopefully we're going to do some more production and storage revenue there, and a little more services and other. So that's how I get to my 14,597. I want to say, Rob, was it 14,594? Something like that. So spooky when we independently arrive at numbers that's similar. All right. We do differ greatly on the automotive cost of sales. And I'll just say it now. I hope he's right and I'm wrong. I see a lot of cost pressures. I see a lot of headwinds. He sees a lot more volume and economies of scale levering against that. And either he'll be right or I will. Or it'll be somewhere in between, one of those. Yes, James, those are always the outcomes. All right, so we got the total cost of sales here at 11.4. What does that leave you with? $3.1 billion worth of gross margin, which would be a new all-time record. Hooray for that, to go with the all-time revenue record. At a little bit lower gross margin. This is lower because I think the regulatory credits and the automotive and energy and services are all going to wash out to that number. Then for research and development, I've got a very similar forecast here. SG&A, I've got a breakdown of later that I can walk you through how I get to this number. It's complicated. Hopefully no restructuring and other. I haven't heard about any layoffs or anything. So that gets you to income or loss from operations, 1.5 billion-ish. And then just some other below the line items here: interest income, interest expense, other income. These ought to be small, I hope, except for the interest expense. Maybe one of these quarters, Elon will just get fed up with the long-term debt and pay it all off in advance out of cash. And then we'll have a zero here, but I'm not forecasting that to happen for a while. And then here's where we put our income taxes. So the one that I'll point out here is, if you're looking for where I have that favorable income tax credit, there's the first 80% of it. This number would be higher by $1.6 billion if I didn't have that in here. So we would be paying a lot of taxes on these earnings starting Q4, if not for that one-time item that's favorable. And that gets you to the bottom line profit. So let's see what's on the next slide. this one's given us some per share info. So if you want to know what the earnings per share are, you can look at share count two ways, basic or diluted. Diluted is including the shares you might have to add to pay off stock options. So those are included in here. There's also some convertible bonds in that calculation as well. So these are the shares that we know are going to happen, and these are the shares that might get added and dilute some. So the diluted share counts, or EPS, are going to be lower usually for that reason, dividing into a bigger denominator. All right, let's go. So you got some percentages here: automotive cost of sales, leasing cost of sales, gross margin again, and then I've got the breakdown by site for each of these. So you can see for each site, for each model, how many deliveries do I think there's going to be, all in one page on this one. Let's keep it moving. The other direction, the direction we haven't been already. So for slide 22 up here, this starts my detailed model tab. This is a long tab. That's where I'm doing all the granular assumptions that build up to all the summary and chart info that you've seen previously. So I had a much more back-of-the-napkin approach to forecasting before I redid it this way. And my earnings forecast was not always as accurate as I hoped it would be, which I'm fine with if it's for some surprise reason that nobody knew about and it just hits. That's fine. I don't beat myself up too much for not knowing information I would only know if I worked at Tesla, which I do not. I have no insider information. I have no material non-public information. I just guess based on the research that I do on Twitter, on Tesla, on YouTube, etc. So I thought, what is the best way that I could build up to production and deliveries forecasts? And the approach I landed on was, hey, let's figure out what the capacity is for each model, for each site. Figure out how many weeks of production there were at that site for that model, and then figure out how efficient we think they're going to be at producing cars to the design intent of that line. So if this Model S line is capable of making 1,000 Model S's per week, you can see, I probably shouldn't have double-clicked. If I do this, and I do this, does it come? Okay, good. That's snapped back again. I'm going to try not to double-click again and mess that up. Let me draw again. Got a pen. So you just kind of work your way down this list, multiplying these things by each other. So back here in 2020 Q2, even though our capacity was 1,000 per week, if we were only making Model S's for 6 weeks out of those 13 because COVID shut the thing down for the other 7 weeks, and we were only able to be 45% efficient during the weeks that we were open, then here's how many vehicles we could have produced. Then if you know what your beginning finished goods inventory was, and you know how many you think there are in the ending inventory from the production and deliveries report, after that quarter happens, then the math on these leaves you, there must have been 5,124 deliveries. I'll undo that so you can read the numbers better. But that's just the very easy way to walk down one column doing the math. And then of these, you have to determine how many of them are subject to lease accounting so that you can figure out what the revenue was later. So I'm just repeating this process over and over again, the whole way down the page and the whole way across all these columns. And in my model, this is not my last column. You can kind of see that I've grouped, and I can hide all of the columns to the right, which are 2022, 23, 24, and 25 that aren't in the thread. Maybe one day I'll share all those granular assumptions. 69 tweets is a lot. So maybe I'll leave it at that. But that's what's happening here. So if I go over to the Q3 2021 forecast, what do we think happened? Well, there were some Model S's delivered last quarter, 1895. We know that 9,275 were delivered in Q3 because that's what the production and deliveries report said. And they're only made at Fremont. And almost none of them were Model X's. I got this 10 from Troy. So he says 10 of the 9,275 were Model X. So that's how I have this math working to get there and make sense. Then for Model 3 from Fremont, I'm assuming about the same production in order to get to the number that Troy thinks were delivered for Model 3, since those numbers are available now. For Q4, I have to guess at what I think is going to happen. So for Model S, I've got production coming up just a little bit. And I've got more ending inventory happening over here to get this back to a more normal days supply of ending inventory. This is a real low number right here, which is understandable this early in the ramp. I guess they knew where all of these were going. I don't expect a number this low to keep happening because it doesn't represent a normal days of inventory. You just can't. I wouldn't feel comfortable forecasting a very low number for days of inventory, days of sales in ending inventory, which is just saying, hey, how many deliveries were there and how many cars were there in inventory and how many deliveries did we make per day on average over the quarter. And you do not use the 91 or 92 days that actually happened in that quarter. You use the industry standard 75, which I guess is supposed to account for maintenance and downtime and whatever. So tips and tricks you got to know to get this math to come out right and tie out. This is a live model. That's another difference between what I'm doing and what a lot of other folks are doing. When the actuals come out, everybody else has a 5-minute exercise to just type over their numbers. And I have to go back into the detail and figure out, okay, what detailed assumptions should I have made so that those totals would have kicked out at the bottom when you do all the math and add them all up. So it takes me a lot longer to tie out after each earnings report because this detail isn't provided. So I have to figure out what makes sense. All right, so let me move on down the page. I see people pointing at different numbers. Alex or Sawyer, do you have questions about the deliveries subject to lease accounting? No? All right, I'll keep going.
I think we were just like trying to follow you along because your cursor is showing differently for us than it is for yourself.
It is? Oh.
Yeah, so you're red and it says James Stevenson under, and your pointer is probably just a normal mouse pointer.
Yeah, well, it's a pencil right now.
No, it's still a pointer.
Highlighter.
Yeah, the highlighter would probably work best.
The highlighter works. All right, I'll start drawing more with the highlighter. This is my first time doing this, so.
Yeah, no problem. Good job, though,
and
so far.
Maybe people will be so sick of me at the end of this one that I'll just refer them to the YouTube video from now on and say, I already explained this once. Go watch the video. All right. So walking you through this, there's Model S, there's Model X, here's Fremont Model 3. Hopefully the Fremont Model 3 picks up. I've got more production efficiency expected soon out of them to get more deliveries. More people want Model 3s. and Tesla should be working hard to make that happen. Likewise for the Model Ys, they are producing flat out to get these done because they're quoting people ordering today, April, May, and June, I think, for delivery dates. Yeah, here's my 89% assumption for what's going to happen in Q4 to get us, hopefully, more production, a little bit more production out of Fremont for Model Y, which ought to leave us more deliveries if the ending inventory is about the same. That's what that math is telling you. So Shanghai, let's board a plane to Asia and land in Shanghai. See how things are going at Tesla's most cost-efficient plant. So the year's been looking pretty good. I guess I should leave the headers on so people know which year and quarter are which. They're booking, making a capacity of 5,750. I think it's going to go up some more in Q4. They were on a tear in Q3. These are big numbers, big beat, both here and here. Really ramping up solidly from a 32 in Q2 to a 60 almost in Q3 for Model Y. So if they can keep ramping up at that pace, Katie bar the door, I think they're probably close to nearing the point in the S-curve where this slows down some. So that's how I'm getting to my vehicles produced. And vehicles delivered should go up some. I don't want to forecast really aggressive numbers here and then be doomed to miss high. So that's where I've got those assumptions. Shanghai Compact is here. I guess I should mention this hasn't even been announced yet. I just have a place held in my model for it for if it happens. Then Berlin Model 3, not on this timeline, probably not going to happen Q4 of 2021, but I do have that coming online maybe at the end of next year. Berlin Model Y, okay, they're, as far as I know, they haven't even made one yet, and we're in this quarter. So if the production capacity of that plant is starting at 3,000, maybe on one shift, and if they can get 2 weeks worth of production at 15% capacity, I'm really trying to read into it as much as I can from what Elon said. He's hopeful that we'll get some delivered by the end of the year. So I have set my expectations accordingly with, okay, maybe they'll get 900 Model Ys built at Berlin by December 31st and deliver 600 of them to happy customers with maybe another 300 left in inventory. Got to plan for something to be in the inventory. So those are those assumptions. Guaranteed to be wrong. Only question is by how much. And then here I have for the Berlin European model, there's supposed to be a design studio set up in Berlin where they make something that the European market is going to love. I think if I had to guess, something like an upscale VW Golf size form factor vehicle might be, but of course with Tesla, touches and flourishes could happen one day. So I've saved a spot for that in my Berlin section. Then we head right back to Texas, to the Lone Star State. Check in on Austin, looking good. Good to have the annual meeting from Austin last week. And I'm hoping that they've got a capacity of 3,000 from the outset, maybe a few more weeks of production. They seem to be maybe a little ahead of Berlin. If they can produce at a 15% rate, which is typical with all the stops that happen on the line early in a ramp, then maybe they get 1,800 vehicles built. If 500 of those haven't made it to their buyers yet by the end of the quarter, then they'll have 1,300 deliveries in Q4 next quarter. But I don't think this number is going to be wrong by a lot. I'm not going to be high by more than 1,300. And I don't think I'm going to be low by a lot. I don't think they're going to just crank out a massive number of Texas Model Ys and really surprise me. Cybertruck needs to happen starting in 2023 is what we've heard from Elon most recently. It was not that long ago in Q1, the website still said end of 2021 for Cybertruck. They were really hoping they would have the cells. They don't have the cells to make it yet. So as the 4680 production gets scaled up and smoothed out, I'm hopeful that some Cybertrucks will start happening, but not in the next 2 quarters. Same with Semi. It needs lots and lots of cells. That's a thirsty demand spec for a vehicle if you want it to be able to tow full load for that far. You're going to need probably 4 big battery packs, which I imagine is how they've engineered the mega charger to basically just be 4 big packs that you charge all at the same time with one cable that's really a bundle of 4 cables, one for each of the packs. And that leads us down to the all sites and models total. I'll leave these headers up here. So I make these guys purple just so I can easily spot where my total production and my total deliveries are. Now, you may notice that this number, 241,420, is not exactly the same number that was reported by Tesla on the production and deliveries report, but it always comes in a little higher. There's always a few hundred more that sneak on by the time the earnings release comes out, which, by the way, will be Wednesday afternoon next week. I know we're all looking forward to it, which is probably the reason half of you are here, trying to get your fix on Tesla earnings before it really happens. And hopefully we get a lot more production Q4, continuing this trend that we've seen. 180, 206, 237, 273 doesn't feel wrong to me. This is a little higher than what I saw Troy published. I can look at his number after I publish mine and compare notes, see how far off I am. I've got a couple of lines here that help me tie out to the day's sales ending inventory on a 75-day basis. Sorry that I've got like my working notes on here and everything. I just can't invest the time to make a version of this that I publish versus a working model of this that I use to make the forecast. All right, so this is 25. Let me scroll down over here and get to 26. 27. I'm supposed to go to 27 now. Okay, so I've got sections in here that total up Fremont, total up Shanghai, and total up Berlin. For anybody who's curious what each of those sites are producing at this level of detail, these are my best guesses. We never find out what the actuals were for sure, but these are what I think happened. Let me move on down to slide 28. So that's the total Texas. You don't get very much on that because not much has come out of Texas yet. And this starts section 2. So section 1 was production and deliveries. What do we think they are? How do we get to it? What's the best way to forecast it? Now we get to ask, okay, for each of those vehicles that we sell, what's the revenue that we're going to be able to collect? And that's a harder question than I thought it was when I set out to make this model. And maybe I'll skip down one more slide so I can see the full walk down. So Fremont Model X. These base prices change based on how Tesla prices them. So you can see 2018, the base price for Model X was 91 grand. They dropped that to 85. It was as low as 81, 79, 75. at the end of 2021. And then it came up a little bit when they stopped delivering 2021 Model X's. To take those lines down and redo them, I think the line can now make either Model X or Model S. And that gives them the flexibility to schedule production of each of those relative to whatever the demand logistics are that make sense to maximize the value of the orders people have placed, and be really nimble about not tying up a lot of the factory's footprint with separate lines for S and X. So I've got this jumping up in Q3 to 91,500, which is what you got to pay for a base X these days, and a little higher in Q4. Now this is a jagged number because price changes don't work the way you would think they work intuitively, unless maybe you've got experience working with pricing. When you cut prices, you have to honor the new prices even for people who have already placed orders. So when you cut prices, the negative, the unfavorable impact hits your revenue right away. When you raise prices, assuming you have a backlog, now the legacy automakers don't have to worry about this very much because there isn't a long backlog for any of their products. But when you're Tesla and you've got a 6-month backlog trying to fill for Model 3 and Model Y, you've got a problem that when you raise prices, it's not right to make the people who already ordered their vehicle pay that higher price. That's a bait and switch. So there's a time lag between when you raise prices and when you actually start getting more revenue from the people who placed orders after the price increase went into effect. So those prices are going up, and I've got those modeled for 2022 to go higher. It impacts Model Y and Model 3 more. But there's a lot of people waiting for Model X's as well, so there were a lot of orders in that need to get filled because so few have been delivered this year, maybe just those 10 that were delivered in Q3, plus some of the old ones back in Q1. So what do we have to think about besides the base configuration? Now, well, what else are we charging for? So paint, none of the paint options are $1,325, but that is my best guess at what the weighted average mix per Model X is when you guess at the take rate for the free color versus the colors you have to pay for. So this number is the product of it's the sum product of the take rates and the prices for the various paints. I think if you average them out, you've got about this much revenue. Then for the performance package, the amount of this performance package changes based on what the base configuration is. Sometimes the base configuration is higher, so there won't be as much trading up because you've already been forced to trade up into a higher option config. So an example for that would be, let me scroll down to the Shanghai Model Y here. These base configuration prices are higher in Q1 and Q2 than they are in Q3 and Q4 because they were only delivering long range Model Ys here and here, and they started delivering SR Model Ys made in Shanghai in Q3 and Q4. So those prices are coming down, and this is a clue, if you're looking for clues, onto why I'm not as aggressive. There are some bulls on Twitter claiming that Tesla is going to report 30% automotive gross margin, excluding regulatory credits, in Q3 of 2021. And I guess I'm going to hate hearing this replay on YouTube later if I'm wrong about that. And that's exactly what happens. But I do not see any path to a number that high, particularly given Tesla has never hit 28% before. I hold out little hope that a 30% could happen already. I'd love to be wrong about that and see them turn in a monster number, but with the cost pressures we're seeing this quarter and with changes like this where ASPs are coming down, and it's flowing through all the way to the bottom line. This is the top line base, and the bottom line is also lower. Even if the costs have come down by some, they probably haven't come down by this much. So your cost of sales percentages might get worse. The other items here I haven't talked about yet. You got a option for upgraded wheels, option for different interior and seating configs, and each of these are doing the same thing I mentioned with the paint, applying the sum of each option and its price and its take rate, and then getting the weighted average for that model from that site. So that gives you your cash buyer ASP after you add in the delivery options at the time of order. So full self-driving is one of those options. I had been assuming too much back here, but I can't go back and change these because all my numbers are tied out from back here. We found out on this earnings call that the take rates in Shanghai are still very low on FSD. I guess they are not believers that it's going to happen anytime soon. Maybe Tesla can prove that wrong, and we'll see a much higher revenue per full self-driving order from Shanghai. Then for the leased vehicles impact, you actually have to back out money for that because there's a difference between total revenue per delivery and cash buyer ASP. When people lease a vehicle, they're not giving you what the cash buyer is giving you. Cash buyer hands over a cashier's check for, the amount of the car, and Tesla takes that money to cash right away. A lease buyer is just going to make you payments for 36 months and give you the car back. So it's still a good deal for Tesla because they get the car back at the end of 36 months. It's going to have a high resale value because depreciation is very low on Teslas. So it's worth it for Tesla to lease vehicles, but they get more cash by selling them to cash buyers. So the preference is let's make the cash by selling them outright, but let's also offer a leasing program attractive enough to get some business here that'll get us used cars we can resell later. And come out way ahead on that transaction. Destination and delivery fee, you got to pay to have it delivered to you no matter what. Even if you go to the Fremont factory and pick it up yourself, or I guess the Shanghai factory and pick it up yourself, still have to pay it. Regulatory credits, you can see these jump around quite a bit. I think the amount in China is $2017 per vehicle. I've only recently come across that info, which is why it wasn't in Q1 and Q2. But there's been some confusion on Twitter about how that works. You don't wait until the Chinese government pays you to declare like this big lump sum of revenue that falls straight to bottom line earnings whenever they get around to paying you for the regulatory credits. That's not how the accrual basis accounting is supposed to work. What happens is Tesla says, even though they don't get this cash at the time of sale, they say we're going to get that cash. So we're going to declare the revenue now. So every quarter, this regulatory credits amount is reflected in the total automotive revenue. And then later, when the cash comes, the cash goes onto the balance sheet and it relieves a revenue, a receivable. So when you hear people complaining about accounts receivable, hey, why does Tesla have such a big accounts receivable? Well, one of the reasons is this. There's a long lag time between when you earn regulatory credits in China and when they pay you for them. And during that interim, you just build up an accounts receivable balance for it. I'm not an accountant, but I have to dip my toe in enough to understand how this stuff works and make a good forecast. So I also have a line here, revenue for this model, just to help me get a feel for the scale of how much revenue is this model going to make, because I don't have the volumes here to add context to the revenue per vehicle. Yeah, so this is one of the big pieces that's making my automotive gross margin number a little lower, is I expect for these prices to come down at the same time that the costs, which we'll see later, aren't going to get a lot better in the current environment. All right, so this was slide 30. So I can go to 31, no, 32. There we go. That's got nothing on it, so we'll skip one of these, pick up the pace a little bit. Berlin Model Y, here's my starting assumptions for what that ASP is going to look like. 34. There's the Texas Model Y, so you can see what I think we're going to be getting for those. Not a lot of new information to talk about there. And then I total up what these ASPs are. For all sites and models, it's a weighted average number here. And then I've got it by Fremont, by Fremont, by Shanghai, by Berlin, by Texas. And then that gets me to this total revenue section. So how much revenue are we talking about? Most of the revenue is regular sales to cash buyers. Smaller amounts of revenue come in for leasing revenue, and these numbers get tied out to numbers that Tesla does report, so I know these are right. And then this is the combined total of these two sections above, how much total automotive revenue was there. I went the wrong way. Okay. And the rounding out the revenue, we've got some statistics down here.
Just wondering, James, if you could maybe call out which tweet you're at and actually point at it, because I lost your pointer.
Oh, sorry about that. So I was on 38. I'm now on 39. Thank you, Alex. So I'll underline up here.
Yes. Yeah, okay. Yeah.
Total
perfect.
Tesla automotive leasing and revenue by model is this section here. I've got a revenue check figure here to make sure no gremlins have crawled in and chewed on the wires of my spreadsheet. And then right below that, I start thinking about the energy business. So solar deployed, megawatts, storage deployed megawatt hours, solar revenue per watt, storage revenue per watt hour are some stats that we get in the earnings release. So I figured I would put them here too and help to inform and act as a reasonableness check against what I'm assuming for the revenues here. So I've got these guys in yellow to remind me that when I come back to tie out Q3, these are the cells that I'm going to need to change to get the total energy revenue to tie. So really forecasting these is about guessing how much growth we think is possible for these future quarters. It's kind of a guessing game. And then for these metrics, the revenue per metrics, shouldn't these be decreasing over time? Well, they were kind of increasing for a bit, and they've kind of been decreasing some now. You never really know what you're going to get with this number. So I'm hopeful that there will be further cost decreases, or the revenue per watt ought to go down as this gets made more affordable for customers. We're still on revenue here. And then I've got by product over here. Okay, what does the energy division sell? Well, they sell solar panels, they sell solar roofs, and those are what production is when you talk about the solar deployed. Then the rest of these guys are boxes of batteries, Powerwall, if you like the small size, Power Pack if you like the medium, and Mega Pack if you like the Grande, Venti, whatever Starbucks says the big one is. It's just a whole container truck full of batteries that you would buy if you were a utility, a major utility, trying to back up your grid and make sure it's resilient to power outages. And there's some junk that always hits as other, which is always pretty small. So $801 million hit in Q2. I've got that going up to almost $1 billion in Q3 and then 1.3 in Q4. I hope these numbers come in. We'll see how it goes. We get promised that the energy business is going to grow all the time. It has been growing if you look at these numbers. Q1 is seasonally low, which is why you see this one down. Not a lot of folks want to have people on their roof in the dead of winter. So I think that's the reason that we see some seasonality there. And the total revenue. So we're back to my $14,597,000,000 here. And we know we've got the right revenue number going. All right, so well, I guess I should talk about regulatory credit revenue. This is where we see the net growth rate. Is this going up a lot or is it coming down a lot? It has come up a lot in the past. And I'm expecting that it's going to keep going down because that's the guidance that Zach has given. That's what these decreases are. Trying to get that revenue down for the locations that aren't China. For China, we kind of know what we're going to get because it's being declared as the vehicles are being delivered, but it's more of a guessing game for the other regulatory credits. So that's the end of the revenue section. There was a Fiat Chrysler agreement that I had to pencil in up here as well to make sure I didn't overcount the amount of money they were going to pay. So that's revenue. What do you do after revenue? You do cost of sales. Figure out, hey, how much is it going to cost us to make each one of these models? Fremont Model S had been costing a lot. And then over the years, it came down and down and down. So by the time you get to 2018, the base amount of cost per Model S was pretty good, and the bottom line number also pretty good. So towards the end of 2020, the production came way down. The costs get worse the less you make. The costs get better the more you make. That's economies of scale for you. So these costs are high. For Q2 and Q3, where not very many Model S's were being made or delivered, and I'm hoping that comes down in Q4 as that ramp ought to be over now for the Plaid Model S's. So this is still a lot of money left over at what Tesla's charging for those. Model X, I've got a pretty insane number right here. James Dauma asked me about this one on Twitter yesterday. Hey, are you out of your mind? The cost cannot be $259,000 per Fremont Model X. And under normal circumstances, he would be right, of course. But I mentioned up top, according to Troy, there were only 10 of them delivered. And you can't keep an automotive production line running for very long without ramping up to at least this much cost for that tiny amount of vehicles. So that's what's doing that. Hopefully that number will come down and down and down into the future, and we'll see really good profit margins on those refresh Model X's. Fremont Model 3, these are great. Costs are low and improving for Model 3 over time, and So the cost, I've got $100 worth of cost in here for full self-driving because it's not nothing, uh, but it's a small number compared to what we charge for full self-driving, right? And then, yeah, the amount of the performance package kind of depends on which packages are being offered over time. And Model Y, early on in the ramp, you expect a high cost because you have low volume being produced and delivered, but those costs should come down over time. Maybe with some cost pressures here in Q3 and Q4. Now, maybe I'm being too conservative on these. Hopefully I'm not. I'm thinking lower performance packages for Model Y as they've made a whole bunch of those. Maybe that'll be less of a component in the mix, and those costs will come down some. I do have the costs growing here for the base configuration. Trucking is having shortages right now, and you have to truck these across country from Fremont. So maybe some of those cost pressures are going to materialize. Maybe they won't. Maybe we'll do better than this. So that was slide 40. No, it was slide 41. I just can't figure out. I guess these are below the slide. They animate. Okay, so I'll head up to slide 42. And we'll look at the Roadster, Shanghai Model 3. We can see that it was very expensive to make early on, losing money for sure when hardly any of them were being made, but those costs continue to come down. It's a lot cheaper to make vehicles in China than it is to make vehicles in California, which was one of the major business imperatives for getting a gigafactory in China first. That's where you want to do your expansion. What a coup it was for Tesla to land a wholly owned auto plant in China after so many predecessors got a 50-50 joint venture with the Chinese government. Really underscores the faith the Chinese government has in Tesla and their support for what Tesla is doing. And they also, loaned Tesla the money to build that factory, which has an incredibly high ROI with how profitable these are when you compare what Tesla charges for them to how much they cost to make once they have ramped up. So I've got Model Ys here. You can see what I'm expecting here for costs. So here's a good example of, hey, the high-end packages were all they were selling in Q1 and Q2, so there wasn't much long-range or performance package buy-up to be done. Now that lower cost models are available, maybe we've got more trade up into performance packages on standard range vehicles, Model Y. So we'll see if that materializes. Maybe I'll have gone too conservative on it, and maybe Tesla will beat my forecast. Berlin. Not a lot to talk about here. Costs will be high when they first start making them, if they can get any out in Q4. Same thing with Texas. They're only going to be able to produce this one model if they can get any out the door at all. So high costs expected there. But over time, these costs ought to drop below what it costs to make Model Y at Fremont. One, because they'll have front and rear castings. Another, because once they've got the 4680s figured out, those will be lower cost battery packs. So those will be money makers before very long. And Cybertruck and Semi will come later. We've mentioned already. And I've been scrolling instead of hitting my button. So 46 is this one. I'm going to go to slide 47, which shows the total costs. You can see how much money we're talking about, billions and billions of dollars worth of cost required to buy all the materials and the parts and assemble them all together and pay the people who did the work. So, big money there. And if we look down to slide 48, this will give us the rest of the costs for the energy division: solar panels, solar roof, power wall. These are costly. The percentages are high on these, which we'll see a little bit later on when we get to it. Zach did note that the Q2 Model S lost money, or was a break-even proposition, something like that. So once you have cost of sales, sorry, I'm going to jump back up for a second. Once you have cost of sales, your gross margin is just the revenue minus those cost of sales. And you can see what the gross margin percentages are right below that. So looking back historically, you can see these gross margins are not similar to this number. 24 is a lot better than what we've averaged in the past. So I'm not expecting that to keep getting better right away, given the cost environment that we're in. So yeah, I'll talk about the Fremont Model S here again. These total costs of sales per delivery ought to get better. This next section is just taking the cost divided by the revenue. That tells you how many pennies you're spending on every dollar that you charge someone to buy the deliveries from you. So we'll see better and better Model S as that ramps up. Model X, we got the same story here, wacky numbers at the bottom line and at the top line for these first couple of quarters when we're still at low volume and trying to work out all the kinks, trying to make sure the line keeps running, stoppage time, you're still paying for the labor even if the line isn't moving, right? So you got a lot of considerations that add up to you don't want to be aggressive right out of the gate on how much money these are going to make. Fremont Model 3, these are looking pretty good. I've got this pretty steady from Q2 to Q3 and then getting better in Q4 as maybe all this sourcing and logistics stuff will get worked out on the trucking side anyway for domestic deliveries. Okay, so now I'm on slide 50 where Fremont Model Y is. So at the bottom line, hopeful that this stays about the same in Q3 and Q4 as what we got in Q2, or perhaps a little higher this quarter. It's hard trying to think of what to say on all of these. Let me go back to 51. So slide 51 has the Shanghai Model 3 and the Shanghai Model Y cost of sales percentages on it. So they're shipping a lot to Europe, and shipping to Europe costs you money because you have to pay more for those rows, which are at a premium right now. Again, insanely high cost pressures right now on over-the-ocean shipping, but they don't have a better option. I don't think the Orient Express makes it from Shanghai to Central Europe. So if you can't send it by rail, you got to send it by ship. And there have been a lot of problems with that lately. So maybe a little bit higher this quarter and next quarter as that situation tries to unwind. And same situation for the Shanghai Model Y here. Let's go to 52. So on slide 52, maybe I'll move that to the top so I know where I am. We've got the Shanghai Compact and the Berlin Model 3, and it's all dashes. So we'll keep going to slide 53. All we have here is the first quarter Model Y comes in. It's going to be a money loser at volumes that low. For slide 54, we've got the Texas Model Y, Giga Texas. The only numbers on here are just indicating, hey, the costs are going to be high because you got to pay a lot of people to come in and work this line, even though it's going to be moving at a slow speed and taking frequent breaks. The line does not move quickly because there's all kinds of problems that need to be ironed out, whether those are, automation or what have you. I don't want to pretend to be an expert. I'm going to skip down to the cost of sales percentages by model. So you can see that header is on slide 55, and then that's row 1091 of the spreadsheet. But on the very next page, I had to cut that off and make the first row 1092 so that I could fit the automotive gross margin at the bottom of the page. I want these slides to fit onto a PowerPoint. I actually make it in Excel. I move everything to PowerPoint. I create PNGs out of it, which are Twitter friendly, and then I make tweets for each one of them and attach them one at a time. That's how the process works. Now you're behind the scenes on how the magic works. So these are just showing you at a glance for each model what these cost of sales percentages are doing over time. And if you could see 2022, 23, and 24, you would see that these are expected to get better as time goes by. Those cost pressures ease up and efficiencies are gained. That was the bottom of the page, right? So I'll go to slide 57 next. Slide 57 is showing us the cost of sales percentages for the energy division. Energy division loses money sometimes, like you can see in Q3, Q4, Q1 of 2020 going into 2021. These were not good Tesla energy cost of sales percentages, and they're part of the reason that we got a price increase on the solar production, because it's not a good idea to run even a subunit of a business at a loss for that long if you've got an alternative, and the alternative is raise the price. And even if you have to sacrifice some volume, at least you'll be making some money and buying yourself some time on them. But my forecast has these getting a little better in Q3 and Q4 as hopefully the new prices are working out better. Then for services and other cost of sales, service, supercharging, Tesla does not overcharge for that stuff. So this is a break-even business, or maybe a little worse than that. And that gives you the total cost of sales and the total gross margin, which we saw before. So that's it. You've made it to the bottom of the granular assumptions section of my detailed model tab, which takes us to the income statement. Now, we saw an income statement summary earlier in the deck, and it had all these same numbers on it, but they were coming from here. This is where I do all the adding up of everything above it. So the 1,100 rows above this were just figuring out the revenues and the cost of sales and the gross margin. So these numbers here are the product of all the detailed assumptions being made up high. I just really felt strongly about doing it the right way and building up to it. So yeah, here's the revenue I'm expecting. Let's hope that comes in for Q4. Should be strong growth on top of that, strong delivery growth. It does wonders for P&Ls. The more you sell, the more you make. Sorry to break it to you, short sellers. That's always the way it's worked. If they had just studied some economics and understood scale economies, they would have not made their mistake. Oh well. So yeah, there's your gross margin, over $3 billion. maybe close to $4 billion in Q4. We'll see how that goes. I am going to revise this forecast after I read the 10Q actuals for Q3, and that'll be my 2 for this quarter. Every quarter I publish 2 updates to my forecast. Once after the production and delivery reports, and once after I've had time to absorb the 10Q and update this model and make assumptions about how it's going to change going forward based on the new guidance. So all the rest of these we talked about when we saw the earlier income statement, including these shares and earnings per share numbers. So I will move on from 58 to 59. Man, we're getting close to 69, aren't we? So there's a lot of fun stuff here. And this is a couple of different things. If you look here at row 1203, I've got a Tesla stock price forecast. Now, why do I put that in here? I have to. I don't have an option. This is needed to figure out what the market cap is, to figure out whether Elon has has hurdled all the bars for his stock compensation plan. So I've got a bunch of calculations in here that are related to that. I've got a trailing 6-month average stock price. Well, I should say I'm calling my stock price forecast 40 times the next 12 months adjusted EBITDA. Now, not everybody likes this, but it's true. Stock prices are based on future expectations, not past performance. There is no lifetime achievement award in stock prices. Stocks are valued at the present value of all future cash flows discounted back. So what people ought to be doing when they decide whether to buy a stock or not is to forecast what they think the future cash flows, the future earnings for that company are going to be, and then decide what the right price is to match. So these numbers aren't all that far, if you look at each of them every quarter, from where Tesla's stock price has been. Now in 2019, they were way off. So you see a 200 here in Q2 2019. You may remember that the Tesla stock price was below 180 back then, pre-split. So that's $45. So this is about as disconnected as this methodology got. And I was buying shares and call options back here. That was a smart time to invest in Tesla for those of you who did. You made the right decision. For the short sellers who bought $50 puts, they lost all of that money for sure. But as you can see, it's really kind of catching up to where we are today. Q4, we're not that far from $877 right now. And last quarter, we weren't that far from $740. And the quarter before that, $619, wasn't that bad, I guess. And I'll talk about Stevenson Indicator later. A few people wanted me to mention that funny technical analysis metric that I tweet sometimes. So the trailing 6-month average stock price I use to get the trailing 6-month market capitalization, which I feed into my model that tells me how many of the stock options Elon has earned and how close he is to achieving the ones he hasn't gotten to yet. We're past $650 billion now worth of market cap and have been for 6 months, including the last 30 days. So those are all marked off the list, I believe. At this point, he still has the milestones for revenue and adjusted EBITDA left to earn for a few of them. You can't get the options vested without doing both, the market cap and pairing it with one of the revenue or adjusted EBITDA goals. So I've got those market caps here. So you can see once it gets to 650, it's done. Once that number has been achieved, it has been achieved. Then, but if you wanted to know when he passed these other ones, there they are. Quarterly annualized adjusted EBITDA is another number I need for that calculation. So how many of these have been achieved? I'm thinking 8 this quarter, 10 next quarter. So he's just mowing down these adjusted EBITDA goals if my forecast is decent. Then the quarterly annualized revenue is another one, and 20 was achieved very quickly. Before the end of the first year, this plan went into effect a few days before the end of Q1 2018. And 35 is already in the rearview mirror. 55 will be real soon. And he'll keep going on those. You only have to make 12 out of the 16 to vest all 12 tranches. That's what this CEO bonus plan achieved is doing. So we're keeping up with the milestone goals achieved. And cumulative CEO bonus shares issued. I say issued as they vest. So those are available to be purchased. Elon hasn't purchased any of the ones under his 2018 plan yet. He'll probably purchase the ones under the 2012 agreement first that he still hasn't exercised. He earned them a long time ago and just has to exercise them and then pay taxes on them. Bradford Ferguson did an excellent video with Dave Lee earlier this week on that topic if you would like to watch that on YouTube to find out how much of that Uncle Sam is going to make. And I'll go ahead and give you a spoiler alert and say Uncle Sam is helping himself to more than half of the options Elon earned through his hard work. So you can share that information with the next person who says billionaires don't pay their fair share of taxes. So I've got some other numbers here that match with what Tesla reports about the goals that are probable and unrecognized or not probable and unrecognized. And then I've got the CEO stock compensation expense as declared in the earnings. This is a non-cash expense. This is purely an accounting convention. It's a requirement of GAAP that as progress is made towards earning these options, you have to say that expense occurred as though you had really had to pay money to your CEO along the way, which did not really happen. So the Wall Street analysts will back this out, knowing that it didn't really happen. And he's not the only one who makes stock compensation. Everybody else at Tesla earns stock compensation as well, down to the line workers. Everybody's entitled, I think after a year of service, to earn stock options that are valuable. And then there is non-stock SG&A expense. This is like the corporate headquarters and the people who do not work at a factory location involved in the process of making cars. So if you work in, marketing or sales or finance or some other corporate role, that's where all the expenses related to those positions are. And that gives you your total SG&A. There's also stock compensation under cost of revenues, which is those line workers. Research and development employees are in stock comp. And restructuring and other is payouts if you lay people off who were owed stock options already. So that gives you the total stock comp, and that adds up to non-GAAP earnings, which I've done 2 different ways to make sure I did it right. So that was slide 59. I'll move on to 60, which is the next one down. So we've got our non-GAAP earnings here, which you can see as a percent of revenue, if you like that number. These are good. I mean, these numbers don't look all that impressive, but they're getting better. And in the auto industry, that's kind of a wacky number because the Q4 deferred tax benefit. But these are good numbers. In the auto sales business, you don't find a lot of automakers that are doing double-digit earnings on this line. So you got non-GAAP earnings per share here. Here's my $1.55 again. A lot of people think that Tesla's going to report a better number than this, and I hope they're right. So the PEG over here is talking about the numbers you need to figure out what the PE ratio, PEG ratio is. So there's a difference between PE ratio and PEG ratio. What's PE for? A lot of people use it for comparing companies and saying, is this one overvalued relative to that one? Or is this company overvalued relative to where we think they ought to be for their industry? That sort of thing. But that's not the way that you should think about a company that's growing earnings rapidly, because there's a huge difference between the future earnings potential of a fast-growing company versus a mature company. So when you see somebody say Tesla has a high PE ratio, well, yeah, Tesla has a high PE ratio. Check this one out. 69,394 was the earnings growth rate, because we just passed zero, right? So in the prior year, the earnings were $0.00. And if you grow that to $1.84, you get an enormous percentage, right? And in the following quarter, 10,369. Well, yeah, if the prior year, next 12 months non-GAAP EPS is going to be 2 cents, then this year's number over last year's number is going to give you something crazy, right? At the point at which you pass from losses to profits, you have very low profits, and that's going to distort that PE ratio. That makes sense, hopefully. So yes, the PE ratio can be bonkers high for a little bit, but it gets lower quickly as you earn more, and things start to normalize some. What do I want to say next? Oh, I've got Peter Lynch over here. Peter Lynch was a very successful investor. He had the Magellan Fund for 30 years that returned a better annual rate of return than anybody else's fund ever has. And he did it by investing in companies that had big earnings growth. And he used PEG as his metric, PEG ratio. So you take the price and the earnings, and then you set them relative to the earnings growth expected by the company, right? And his rule was those ought to be the same. The earnings growth and the PEG or the PE ratio are allowed to be equal. So a PEG ratio ought to be a better way of figuring out whether a stock is a buy or not based on its earnings growth rate. So that's what these guys are doing. And it's not a perfect way of looking at it. Some of these price targets were a little lower than you would expect, but they're climbing. They're on their way towards where we are today. Make you feel like the stock price isn't totally nuts. Then for 12-month price target, historic PEG ratio adjusted, I've got just one other way of thinking about what the another take at a stock price valuation could be. So I don't have one stock price target in here, but Sawyer wants me to talk about Stevenson Indicator. Here it is. So I just added this to the model recently, and a few people asked me to talk about it. So in, let me see here. Yeah. Maybe I've got this. Yeah, okay, so there's my 728 in Q3. And this was the low. This was the COVID low. That's right. Okay, so the lowest the Tesla stock has traded at since 2019 was in Q1 of 2020. It was in March. And the stock really tanked from a huge run that it made in Q4 because people were panicked and there was a toilet paper shortage and blah, 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 blah. The world is on fire. And the stock really tanked down to, I think, like $72 on March 18th in this quarter. Well, if you take that low and you add $1.69 to it for every trading day since, these are the numbers that you get. And I charted that and I tweeted it out. And my friend Fresh Jiva, Mayur Thaker, deemed it or dubbed it Stevenson Indicator TM, trademark James Stevenson 2021. So if you compare what the actual stock prices were versus these stock prices, they got a little bit higher here in Q1 2021, but most of the time they've been very small variances. So this is technical analysis, which you know is garbage. Technical analysis is astrology for men, or my other expression I'm fond of using is technical analysis is phrenology. Just because I love the word phrenology and not enough people know what it means, that is the pseudoscience of explaining people's personalities to them based on the shape of their heads and the bumps that they find on it. That's what looking at a stock chart is and deciding that you know what's going to happen next. Well, the stock market is not a past predicated event, but I do find it fun to occasionally tweet out this chart and say, hey, folks, you know, the stock goes up, the stock goes down. But in the grand scheme of things, it's been going up $1.69 per trading day for about 2 years now. So this is a good stock to own, or it has been over this long period of time. It's easy to fret when the stock is down some, but it's been up a lot more than it's been down. All right, I've got a reconciliation here between GAAP net income and adjusted EBITDA. That's in the earnings release, so I wanted to put it here too. I've got automotive gross margin shown down here and automotive gross margin excluding regulatory credits. These were great in Q2. Maybe they'll be even greater next quarter, but I feel like we've gotten enough warnings about the chip shortage and the chip shortage and the expedite fees. All of these hints I keep hearing, you know, about how difficult this year has been from Elon make me think that we're going to see a little reversal here, and also some of the other factors that I mentioned earlier with price changes and different options availability. But we don't have long to wait. Wednesday next week, we'll know what these were. And I've repeated down here my vehicle production and deliveries. So that was slide 60. I'll move to slide 61. This is just giving you the revenue in total by type. So if you were curious what the averages are for all the sites and all the models combined, those are here. And I've got the same for the cost of sales. This might be useful for some analytical purpose. And I will hastily move on to slide 62, where we've got the cost of sales percentages by type. Again, that's just the math, taking the costs above by the revenue above them. And I've got the Tesla deliveries by site and model here, which we saw early in the deck. This is where I'm calculating those. I'll move on to slide 63, which we've got the full page look at that partial page we had above, which gives it to you both ways. You can see Model 3 and Model Y combined for all sites at the bottom of the page, or broken out by site at the top of the page. Just as a little reference for anybody who wants one. Then slide 64 is giving us the automotive revenue by model, and the automotive revenue per delivery by type. So these are giving you revenue per vehicle. Again, there is a nuanced difference between ASP and revenue per delivery. That cash buyer ASP kind of in the middle here, this is ASP. Then you've got to make these adjustments for stuff that isn't what the cash buyer paid for their car. So a leased vehicle buyer didn't pay this, and the destination and delivery fee is not really part of the cost of sales of the car. It's part of the transport and freight, and a little more profit for Tesla. And you got regulatory credits, which were not purchased by this buyer. They were purchased by a company that was negligent in their responsibility to produce enough EVs to comply with applicable law. And you've got FSD deferrals, OTA updates, data plans, a lot of other random automotive revenue stuff hitting in here. Now, why are these negative numbers over here and positive numbers over here? It's because Tesla used to have to declare more deferred revenue because they hadn't rolled out enough features yet back here. Like Navigate on Autopilot wasn't out yet. Smart Summon wasn't out yet, right? So the rule is you can take the cash from the buyer when you sell them the car for the full self-driving, but you're only allowed to declare enough revenue to match the percentage of the features that was sold to them with. So people bought FSD expecting a bunch of different features, and Tesla has only delivered a fraction of those features so far. So you have to make this reversal before you can get to the revenue number. And this is an unearned revenue liability on the balance sheet until Tesla earns it by releasing the features. So when everybody has single stack city streets and everything, there will be no more deferred revenue. Tesla can take all of it at once. But over time, this number is flipping to positive as Tesla introduces more things like OTA upgrades, and there's very few of these features of FSD that aren't released as a percentage. That's what's going on there. So full self-driving sales plus other revenues or deferrals. Trying to think what people would care about. GAAP earnings per delivery, non-GAAP earnings per delivery. These are good. Put on a chart and show people that the trend is up. So many Tesla trends are up. Adjusted EBITDA per delivery is really taking off and will continue to do so in the years to come. Let's move down to 65. So on tweet 65, we've got some 12 trailing month numbers. You guys know how much I love 12 trailing months. So for here, you can see what the deliveries are doing, revenue, adjusted EBITDA, non-GAAP earnings. And then this was where I had to calculate the Gordon-Johnson metric, if you just subtract regulatory credit revenue from the earnings, what do you get? Well, you used to get a loss, and now you get profits. He'll probably still lie to you and tell you that there are no profits, but don't believe him. He's not right very often. And then we get to the revenue by division. So we've got that here, and the costs by type. I kind of grouped these a little differently. They might look the same, but I needed these to make those same size statement charts where you do the average dollar of revenue. So I included those in case you wanted to know where they come from or how I calculated them. Then on slide 66, you see those pennies. I got to use the penny sign, which is an underloved key on your keyboard. Hardly anybody cares about pennies these days. And on slide 67, I've got the reconciliation of the non-GAAP Opex to the GAAP Opex to the income statement. So I was mentioning on the very first slide, all the way at the top of the thread, that I'm combining a bunch of different stuff. Well, this is the bunch of different stuff that got combined in together. I'm just showing the math that reconciles it back and says, hey, there's a bunch of different stuff going on here, interest expense, other income, etc., are required to reconcile it back to the number that was reported as operating expense. And we are really near the end now. Slide 68, we've got a slide here for Elon's bonus. And this is complicated stuff that I will launch into. It's a smart compensation plan to give a CEO because it aligns the interests of management with the interests of the stock owners. You want your CEO to run your company's market cap higher, but you also want your revenue to grow and you also want your profits to grow. So if your CEO is willing to work for a zero salary, zero cash bonus guaranteed compensation plan where they don't get paid at all for their work unless they make those things happen, that's a good deal. And that's why I signed up for this performance award package. Plus, I don't care if Elon owns more shares, he holds them. It's almost like it's not diluting the float. He's not going to sell except maybe to pay his taxes. And what do you care about dilution if the market cap has grown from 50 billion, where it was before the plan started, to 650 billion? Well, gee, you've made a 13x on your investment if you were invested that whole time. 12% dilution is a small price to pay for those kinds of returns. Those are not easy to get. So these are the terms of the contract that I just typed in over here. And then the deal is for each tranche Elon earns, he has the right to purchase 1,688,670 shares at a price of $350 per share. This was the price at the time pre-split, which would make $7.1 billion if all 12 tranches of the options are granted, worth of money Elon will pay Tesla to buy all the shares. Yeah, so as many as 20 million shares, 20.264 million I have over here, was the pre-split amount. You got to multiply this by 5, so it'll be 100 million shares that Elon will get to own, well, at least momentarily before he has to sell more than half of them and give them to the federal government, unless he wants to take out a loan for $7.1 billion, the interest payments on which are eye-watering, to say the least. All right, so that's just laying the ground for, hey, what is this plan? The next section down is looking at, okay, what are the probable milestone start dates, probable milestone achievement dates, market cap achievement dates, average years between becoming probable and being achieved. You have to do all this stuff before you know what the expense is going to be. And on my next slide, slide 69, I'm typing in what Tesla reports in terms of what they have expensed, which is on this row here. Started out small and got really big in the middle of 2020 and start of 2021. It's got to get smaller now. So it's a very lumpy and weird expense to have to forecast. But this is how I do it. And then for every pairing of, in this section down here, for every pairing of EBITDA goals. And for the first 4 pairings of revenue, I'm showing here how much expense was declared in each of these quarters. When a milestone becomes probable, you take extra expense in that quarter to catch you up for all the quarters you've missed between plan inception and when you declared it probable. And if it gets achieved early, as it did over here, then you have to pay whatever is left that you thought wouldn't have been probable until later. So that's how these worked, etc. And this one, you can see it's a very lumpy business, and you don't know when probable is going to happen. So it's very easy to get surprised by the expense number, no matter how diligent a job you do trying to forecast it as well as you can. And slide 70 is the last of it. These are math that I have to do to make the logic above work automatically when I drop in the new dates. And you have made it to the end. The end. Yay.
Yay.
I'm going to take a drink of water. That was a lot of talking.
Yeah, that was amazing. Thanks a lot,
That
James.
was super.
Thank you.
Yes. So, no questions? Anybody? Oh, we have a caller. Jared. Do you want to unmute? I think Jared's been stuck there maybe a while.
Yeah, about an hour and a half.
Yeah, this room has been going on for 2 hours and 30 minutes, but you did better than on Clubhouse.
Oh, nice.
Yeah, I think the visual aids actually helped a lot. Yeah.
To not have to paint a picture of everything, right?
Yeah, exactly. And which line you're referring to, I think that was a great help. We'll see how it combines like the audio and the video. Hopefully it will do well, and that both you and Sawyer have a version, and we'll pick the best one.
Yeah.
So James, I actually have one question for you, but I think you probably have already answered it, but I'm going to ask it anyway.
All right.
So back in August for the Q2 earnings, you predicted 244,000 deliveries for Q4 versus the 268 that you predicted now, which is like a 10% increase.
Yeah.
But while you did that, like the Q4 non-GAAP EPS only went from $2.99 to $3.
Yeah. Yeah, it's an interesting question. I don't have an answer prepared for it. I'll say on the deliveries, probably it was just China ramping faster than I thought they would. It's real hard to guess correctly in advance how the S curve of the ramp is going to work. And with Tesla, we have some historicals that we can look at and say, well, the last time they ramped a vehicle, it worked like this. But each new model is a special and unique snowflake. So I try not to get too aggressive on them. And I guess China's going gangbusters on it. So that explains the deliveries piece. The earnings piece, the earnings per share piece, the share count probably isn't it. So that makes it the earnings. Earnings are just the result of everything above. It's what you get when you take all the revenues and subtract all the sales from all the various places. So the best I can do for that is a waterfall chart. So I made one of these and tweeted it out for those who follow me on Twitter that compares. Actually, the first one that I tweeted was wrong because I forgot to update the labels under the bar on the left and the bar on the right. I was trying to work too fast and forgot to update those labels before I hit send. So I added to that thread with the corrected chart that tells you what those bars are. The waterfall chart walks you from, okay, Q2, we know what the actuals were. Q3, I know what my forecast is. For every revenue or expense item in between, how different are they? How different did they get? And I'm taking the revenue way up. So that's good for your earnings, of course. But I'm taking the cost of sales way up with it, right? In sympathy. So when you do that, the gross margin doesn't get all that much better. I've got the SG&A going up. Tesla's been doing a ton of hiring this year, so many more headcount. And they're not all working in the factory where their labor will get recorded as cost of sales. So they've got staff offices in Berlin and Austin and open service centers and take care of superchargers. There's a lot of work to do. So that's the reason why my earnings for Q3 aren't expected to be a whole lot more. And I suspect that's the same dynamic at play with Q4, but I haven't done the waterfall chart to be positive. Is that helpful?
Awesome.
Sure,
Yeah,
it's my
absolutely.
pleasure.
Thank you
Great
so
question.
much.
So let's see. We have Noor as a caller. You're up. Unmute your mic.
Hi, guys. I don't know if you can hear me.
Yes,
Okay.
we can.
Thank you guys for everything. And I'm sorry I couldn't hear all of it. I just came back from work. So I just heard the last maybe 5 or 10 minutes. I was just like, have a question. So I wonder if it's not only one question, probably it's a couple. The first one, we all see the Cybertruck. You can't just choose which one you want anymore. You just pay the $100 now and you just wait. So for whoever, choose the Cybertruck, let's say I want to buy the $50,000 one. I choose this one before and I paid the $100. So does that mean I'm going to be stuck with the $50,000 and everyone after that might pay more?
Well,
Or
I'll jump in and try to tackle that one, and somebody can redirect me if I'm wrong. I think that at the time you place your reservation for a vehicle, that's a handshake agreement between you and Tesla that they're going to be able to deliver you the product you ordered at the price they displayed. So I would not expect for anyone with a Cybertruck pre-order to be charged more than the amount that was shown at the time that they reserved. Anybody want to tack on to that?
I would just add that unless you change your configuration, then you might lose the handshake agreement that you had originally. So, for example, if you reserved like a single motor and you decide when delivery comes that, you want to change to a tri-motor, and let's say the tri-motor, the new price is higher than it was before, then you might lose that benefit. Or if you didn't take FSD back then and you decide, oh yeah, but now I want FSD, and FSD was 7,000 back when it was announced, and now let's say it's 10 or more, then you would lose that that handshake agreement because you didn't make that option choice back then. That's the only thing I would add.
Okay. So we all heard about the meeting VW did, and Elon Musk was part of some of this meeting. I wonder, is like VW trying to license the full self-driving from Tesla? Like under the table, I feel like that will be huge, but I don't know if that will affect Tesla too in the future.
Yeah. Okay. So maybe we try to keep the questions related to the topic of the room and James's expertise. We always have rooms talking about these things, and we can answer these questions some other time. But I want to give priority to people who have actual questions relating to James's presentation, if that's all right, Noor. So I'm gonna.
Yeah, absolutely. Thank you, guys.
Yeah, I'm gonna take the next caller. Hold on. Make Paul. Go ahead, Paul.
Hello, can you hear me?
Yes.
Hey. So,
Yes.
James, I see you have the 2021 estimates, but it seems like you're never going into 2022. Maybe you addressed this already, but kind of why is that?
Yeah, well, that's a good question. I do forecast 2022, 2023, 2024, and 2025, but I don't share those out publicly in great detail. What I do is chart them. So if I can direct you back to, let's see, you would think I would know what all the slide numbers are. So slide 15 in the deck, if you have the Miro presentation up in front of you, I sure hope everybody does. It's greatly enhancing the audio to be able to see what I'm talking about. This chart shows my expectations for just the deliveries and the timing of when each model starts. So I've got models on here that Tesla hasn't even announced they plan to make. So I'm kind of taking some limited risk on here. I mean, it's not wholly without support, but I'm just drawing in here. I've got this Shanghai Compact, I'm calling it. I don't have any solid basis to call it a Shanghai Compact. That's just the vehicle that makes sense to me that would get made next in Berlin. So I've been thinking about it, and I don't only have the deliveries number in the model. I have all of the detail that you saw for the years 2018 through 2021. It's just too early for me to feel comfortable publishing those numbers because it's difficult to have any confidence in targets that far out. I'm definitely going to have 2022 published soon. I'll see how I feel about doing 2023 as well. But 2024, 2025, these are way out there. And that's not the only chart that has it. I've got an adjusted EBITDA chart on slide 7 that really goes nearly vertical into a vertical climb with the increases in FSD revenue that I'm expecting.
And then one more question. So have you done an analysis of like statements that they've made about capacity and then actual capacity for the factories that they've built? Like, because I get the feeling maybe they're sandbagging, but I can't really tell.
We don't have high confidence that the numbers Tesla shares are the design capacity for real. Because that number can be used against them, and it is, right? People will go on television and say, Tesla claims that they can sell every vehicle they make, but if you look at their stated production capacity, they only delivered 60% of it, right? Well, that's bending the truth to the point of being unrecognizable, because the number Tesla publishes is a year-end capacity number after all the models are ramped, and the delivery number that they're throwing in the numerator is a backward-looking actuals, right? So the people who use such tortured logic either know that that's what they're doing and that it's wrong, or they are too incompetent to have their jobs.
Thanks a lot, Paul.
Okay,
I'm going to take Joe as our next caller. There you go. Joe, you're up. Joe, if you can unmute.
Oh, there you go. Hello, guys.
Hey.
Sorry, first time I'm calling. I feel like I should say long-time listener, first-time caller. Okay, so quick question, and I'm sorry if this is Bush League accounting here on my part, but how are the factory expenses recognized? Like, is that because I know it's like voodoo magic with the accounting, you got to amortize it over a long period of time and all this other stuff, but Like, is that, I don't see or any big lumpiness with these two new factories coming online. Is that because the costs are already like being put in, or they get prorated or they start being utilized once it starts producing stuff? And does that impact earnings per share?
Yeah, this is one of those areas where accrual basis accounting actually does get it right. And I'll use as an example a bakery. So let's say that you want to open a bakery and you don't have any equipment to go into that bakery, and you need to buy $200,000 worth of equipment to go in there. If you were using cash basis accounting, you would declare almost a $200,000 loss the first week that you opened that bakery because you had to pay for that stuff.
Mm-hmm.
The accrual basis accounting method gets it right because they say, wait a minute, that's a long life asset. All that kitchen equipment is going to last you for years and years before it has to be replaced. There's breweries that are using tanks that are 100 years old, right? I think GAAP would limit you to 40 years max. But the better approach is to depreciate capital assets over a long time. So when you build a factory, yeah, it costs you $2 billion during the course of that project, let's say, that capital project, but you're allowed to capitalize the expenses associated with it. So the cost of all the materials, all the construction workers who put it up can all get rolled into that capital project. And then you can declare a useful life for the asset of, let's say, 40 years. And then you declare depreciation expense against it according to Maker's table, MACRS, which gives you more depreciation in the early years, kind of like a car. As soon as you drive it off the lot, you take a big hit for the depreciation, right? And that expense keeps hitting until there's no more expense left to take against the initial purchase price. As for the factory workers who are making the cars, are they considered cost of sales? Yes, they are. Under the GAAP treatment, it's not just the raw materials that get shipped into the factory or the parts that you buy from your suppliers or the stuff like that. It's also the direct cost of manufacturing. So that includes not even just the hourly factory labor on the floor, also anybody who is in a salaried supervisory role working at that factory. They count as cost of sales expense, not as SG&A. Did that answer the question?
So is that why the $256,000 for the 10 Model X's, that was not based on the factory depreciation, that was based on the employees?
So the depreciation is going to be on a per vehicle basis usually. So for the building, you might say the building is going to have a 40-year life, but for a robot that works on the line, you might say, hey, this robot can only be expected to turn and lift and twist and drop stuff for 1 million vehicles. So you might depreciate the cost of that item evenly across the first million vehicles that it makes. And either it'll be scrap at the end of those million vehicles and you'll have to buy another robot to replace it, which would also be a capital asset, or it'll still be useful and you'll just have a net zero book life asset that you're able to keep monetizing at no additional cost.
Okay, and then when you talk about just like a car, so in the beginning it's a bigger hit, but then as it goes, it drops. Is that where I always hear this operating leverage really gets going once you scale at a factory, right? So we have 2 new factories that are going to come online. So is that going to cause profits and everything to drop initially, and then over time as they scale up, it sounds like it's about a year, that'll then start going crazy?
Yeah, so I mean, it's like having a diversified portfolio of stocks. If you have 20 stocks, you're going to have some that are huge winners, some that are huge losers, and a bunch in the middle, and they average out to be a pretty good return, you hope. When you've got all these different sites and all these different models, and they're all ramping at different times, some of them are early in the ramp. Some of them are late in the ramp. The ones late in the ramp are making more money. The ones early in the ramp are maybe even costing you a little bit of money in the first quarter or two before the break-even volume production hits. So hopefully all that stuff evens out to steady earnings growth over time, barring unusual circumstances like force majeure, factory closures, insane cost pressures, those sorts of things. So barring really unusual stuff, the profitability ought to continue to improve until all of the models have fully ramped.
Right. So, but just so I'm clear, I mean, right now on the two factories, Shanghai and Fremont, they're like, not, it's still growing, but they're pretty much peak utilization. So they're like the best profit you're going to get. But then two more factories, so 2 to 4, are going to start out really slow. So is it going to have this drop in like earnings per share, or, the profit margin will drop because all of a sudden you've got, half of your, I see, because they're making so few cars, it won't be a material impact. It's only maybe towards halfway through next year or 3/4 that we'll start seeing that drag on gross margin.
Yeah, you want to care about the dollars and you want to care about the percentages. The percentages are bad early in the ramp, but the dollars are small. So they get the dollars get drowned out in the mix by other models that are way more productive at producing vehicles per day.
Okay, and last question. I know I've killed you guys today, but on Elon's comp, you said there's only $500 million left, but like you said, it depends on when it happens, and it's it's hard to predict. But it looked like these last 2 quarters were the biggest ever, and or maybe if I remember correctly, 2 or 3 have been really big chunks. You don't perceive they're going to be that he must have hit 2 tranches in a quarter, right?
So the reason that I went to so much trouble to do those last few pages of the review to get the expense forecast right is because it's just such tortured, convoluted logic to figuring out what the expense is going to be. And I still don't get very close on my expenses, but I'm not way off either. I had initially just been expecting that these early steps would keep happening. And I got surprised by one here, and I was like, whoa, this is suddenly way bigger. Why would that happen? And I had to dig into really arcane accounting sources, and more than a few people had to help me figure out how the process works. Because, if you read the 10Q, they do spell it all out, but it is thick reading, and you're like, well, I don't know how a Black-Scholes model works. Do I need to know how to do that? I did actually get one from Damodaran's model and repurposed it to figure out how to. So I know how to do Black-Scholes now. If I can find that workbook again, it's a complicated mess. But if the easiest way I can explain it is in mid 2020 to mid 2021. Rapid progress was being made towards market cap goals that was not previously expected. And at the same time, the revenue and the EBITDA were getting better. So all of the metrics that Elon needed to make progress towards, he was making more rapid progress than expected. So they had to catch up the expense to the outperformance versus their conservative expectations of how long it would take to achieve all these goals.
Right, but there's so little left now that even if it dropped all in one quarter, which it never will, the company would still be profitable for that quarter,
Yes.
Right? Because they're just making so much money that it offset it.
I do not think Tesla could declare all of it in Q3, but even if they did, the earnings would still be a positive number.
Okay, and then one last thought, just this is not a question, this is a thought, is just that the only reason that I could see them not taking that in the fourth quarter, your big $1 billion or whatever it was loss to net out the taxes, The only way I could see it would be for political reasons. So they showed that Tesla, because they keep getting hit, just like Elon gets hit, saying, "Oh, these big companies are making money and not paying any taxes." That's the only reason I could see why, other than the auditors not letting it. But I just was curious if you agreed, or are you pretty solid that it's going to happen Q4 no matter what?
I agree that it would need to be a mercurial decision like the one you described in order to not do it, because the time value of money is a core concept of financial management, and money now is worth more than money later. If the auditors are good with taking a $1.6 billion contra expense against tax liability, you should take it as soon as they'll let you take it. That's it. It's bordering on financial mismanagement not to take it.
I was about to say, I was going to say fiduciary responsibility. Yeah. Right? It's almost like you have to.
Yeah. So I can't imagine that it'll be later than Q4. Maybe it'll be Q3, and it'll surprise everybody with a giant number. I mean, if you see something that beats everybody's expectations by $1.5 billion, that would be my first guess as to what happened.
And what would the earnings per share be? It would be 2 something.
Yeah,
right?
It would be. Might be 3 something. It would be a big number.
Right, but of course they'll all say they'll just work. It's one time, so they don't care, even though it's
Wall Street,
$1 billion.
Yeah, Wall Street is going to back it out because it's not earned within the period. It's from a prior period, so it doesn't. It's a non-recurring, non-sustainable favorability.
Gotcha. Like the Bitcoin stuff. Okay.
All right.
Well, thanks for this. You're awesome, James. You're awesome. Thank you so much for spending this much time with us.
Sure.
Yes, he is. Okay, we're going to take one last caller. Zero Hero, you're up. Can you unmute your mic?
Hello. Hi.
Yes.
Go
ahead.
So I want to thank everyone here for doing such great work for humanity and helping little guys like us find alpha in these times. Just a question for James regarding his slide tweet 47 out of 69. I'm seeing that Tesla Energy's cost of sale percentage has been relatively flat throughout the quarters. And I'm just wondering if you have any insights on why that's the case, and when do you expect the Tesla Energy part of the business to, take off?
I don't see the margins improving substantially until there's sufficient cell supply to ramp the volume of product delivered a lot higher. This is a tough industry to be in. There are not a lot of solar panel or battery companies out there bringing down giant earnings. It's kind of a low barrier to entry industry. So there's a lot of competitors. They compete on price because they don't have a lot of differentiation. Tesla has differentiation with Solar Roof, which is why I think they're going to try to focus more on it being something that competitors do not offer. As well as to a lesser extent, Powerwall. Megapack is great, and utility demand ought to be really high for that because when combined with Tesla's auto bidder software, which is proprietary, I guess somebody with enough effort could duplicate it. Is a money maker. I mean, you can. The ROI is short on buying a ton of megapacks if you produce a lot of electricity and have a lot of grid instability with your duct curve, or if you're a power company that owns really costly peaker plants that you can decommission running natural gas only at peak usage times of day. So as soon as Tesla can ramp the LFP cells to supply Megapack, that business ought to get a lot better, and you ought to be able to command some pricing for the value proposition of pairing it with the auto bidder software to automatically buy electricity and store it in the cells when it's cheap, and automatically sell that electricity back to the grid when costs are high.
I see. Yeah, thanks for that. Do you know the reason why Tesla will be prioritizing cells for auto business over the grid scale storage systems? Because it seems like the grid scale storage systems would have a higher margin. It seems, I have no actual facts on this matter. Just from like a commonsensical perspective and cash flows perspective, it would seem that the grid scale storage would be a higher margin on cells. Yeah, I was just wondering if you have any comments on that.
My only thought is that it's related to the cost of shutting down a factory relative to the cost of selling less megapacks, right? You don't have to idle thousands and thousands of workers to stop making megapacks, but you do if you don't have enough cells to keep your automotive production lines running. So, I mean, you're making all the money out of the auto business, and that's where your better margins are, and that's where your cost base expense is centered. So that's where you have to feed the cells to first.
Okay, so it's not necessarily a problem with demand for these megapack systems, but rather just that the physical infrastructure is not ready to handle such a business line?
I don't know if that's the problem. It's just that if you've got two different divisions in your company, one of which is generating, let's call it a really decent 24% gross margin ish, and you got another one that's barely cracking single digits, and you don't have enough cells to give both what they need. And if the cost base, meaning the number of people who work at the factories, is heavily skewed towards the auto business, you would not choose to idle those automotive assembly plants in lieu of selling a whole lot of megapacks that you could have made thousands of cars out of.
I see. So then what you're saying is, in a couple of key metrics to look out for on the energy side of the business would be additional factories for or hiring for the additional production of megapacks and cells.
It all goes back to cell supply. Tesla's trying to buy all the cells they can get their hands on, and the world is not making enough.
I see.
Tesla.
Yes, and to your point, they have started construction on a megapack factory in California. So
at Lathrop.
Yeah, Lathrop.
Yeah.
Cool. Yep. All right. Cool. Thanks, guys. Super helpful what you guys are doing.
Okay, so James has been super generous with his time on his Saturday, just over 3 hours. So I want to thank you from the bottom of my heart for coming and doing this with us today.
Yeah, thank you, James.
Absolutely, my pleasure.
Thank you, James.
Yeah, and thanks to the Europeans for staying up late.
Do you have any closing thoughts, James, you would like to share?
Well, thanks for the opportunity to talk Tesla. It's something I enjoy doing, and hopefully, I know not everybody had a chance to ask their question, but if you go to Twitter, you can reply to me. If you're following me, I will see your reply and be able to answer questions that maybe you didn't have a chance to ask during the session. And hopefully we didn't screw up too bad, and the YouTube video will be posted soon.
Yeah. So before you ask your questions, watch the video first, and then ask your questions to James on Twitter.
There you go.
Okay. Well, thank you everybody for being with us. Please make sure to subscribe to the podcast, and we'll catch you soon. Probably the next episode will be October 20th for the earnings call. So tune in, subscribe, and you'll get a notification to come join us. We'll be talking. Maybe James will even be back. He's not confirmed, but
we'll see how it goes.
Exactly. We'll see. Okay. Thanks a lot, everybody. Have a nice afternoon, evening.
Thank you.
Bye-bye.
Bye.